We're going to identify how to correctly account for note receivables. And for the main part, I want to focus on that when we're dealing with the note receivables, we're going to concentrate on the interest part of the note receivable. And so I'd like to just give you a quick example of how to account for note receivables when you're dealing with interest. Okay? So let's say we're in May 1st. And let's say, suppose that we sold a product for $10,000 and issued a 1-year 10% note receivable. Note receivable. Okay? I think that's all we need. And so we're going to go through the life or the maturity of this note. Okay? So the maturity of the note is just equatable to the life, the existence. So we know that this note is going to last for a year. It started on May 1st of this year, and we know that this note is going to finish at the end of May or 1st of the following year, right? So what happens is we provided a product, we sold a product, and so we need to record the issuance of the note because when we sold a product, instead of settling it on our account, we issued a note. So instead of debiting accounts receivable, we're going to debit notes receivable for $10,000. And by the way, this is the issuance, all right? So let's do this accordingly. On May 1st, we have the issuance that needs to be recorded. All right? And so how are we going to record the issuance? We're going to debit notes receivable We're going to debit note receivable for $10,000. And we're going to credit sales revenue, right? We generated some revenue by selling this product for $10,000. Piece of cake. Okay? Now, what's the next part of this particular life of this note? The next step. The next step will be your year-end adjustment. Remember from chapter 3, guys, at the end of the year, you have to make adjustments, right? And remember the 5 adjustments that we talked about. Prepaids, depreciation, accrued expense, accrued revenue, and unearned revenues, right? Those were the 5, right? And so when you have interest could be on 2 sides, right? You could be either receiving interest or you could be paying interest, right? Depending on if you are borrowing or if you are lending. In this situation, we're pretty much, we set up a note, so the other guys owe us, right? We're collecting. So we're receiving the interest, right? But based on this illustration, when will we actually receive the cash of interest? We're going to receive the cash of interest at the end of the life of the maturity. So on May of the following year, we're going to collect cash from this guy of $10,000 plus 10% of $10,000, which is $1,000. So we're going to collect $11,000 from this gentleman, consisting of $10,000, the principal. This is called your principal, and the 10% interest, right? And that's going to happen the following year. But at the end of the year, we have certain obligations, okay? So, as I was saying before, when you're receiving interest, interest is a revenue to you. But when you're paying interest, it's an expense. When you're receiving interest, it's a revenue to you. When you're paying interest, it's an expense. So on the side of the gun in this situation, we're receiving interest. So we're generating interest revenue when we receive it. However, an adjusted entry will consist of an accrued revenue. And accrued revenue is a revenue that you've earned, but you haven't what? Received. And so at the end of the year, when it's time to generate our revenues, generate our adjustments, at the end of the year, December 31st, when it's time to generate our adjustments, right? We have an accrued revenue that we have to account for. We really do, right? We have to account for that interest because we're receiving interest the following year, but we have some interest revenue that was earned this year from May to December, but we haven't received it. So how do we journalize a revenue that you've earned but you haven't received it, right? We debit a receivable and we credit the revenue. And so that's what we're going to do for this interest. So we're going to debit interest, receivable, and we're going to credit interest revenue. Now, we have to calculate the correct amount, right? Because we know that we've earned interest for how many months? We need to calculate it. As I said before, always use your hands. May to the end of May, June to the end of June, July to the end of July, August to the end of August, September to the end of September, October to the end of October, November to the end of November, December to the end of December. That's 8 months, guys. That's 8 months of interest we're earned, but we haven't received yet, right? And so how are we going to calculate that amount? Very easy. We're going to take the principal, which is $10,000. We're going to multiply it times the interest rate, which is 0.10, 10%. And then we're going to allocate that portion of the interest that we've earned. We've already said it was 8 months, right? But the total interest is going to be what? 12. And so what we're going to do is take 8 over 12. 8 over 12. Anytime that you calculate interest, you have to consider your denominator to be 12. All the time. Okay? So, I need my phone because I don't know what this is. Well, I could do it, but I just want to, let's see. So, 10,000, that should be $1,000 times 8 divided by 12. I have 667. Let's just round up. 667. $667. Okay? And so that's going to be our year-end accrued interest journal transaction. And so we only have one more transaction that we have to consider. We only have one more transaction that we have to consider. And what transaction will that be? The following year, the collection. Remember? At the end of that 1 year cycle, we have to collect. So now we're going to record the collection. So a couple of things are going to happen. Like a collection, we know we have to debit cash. And we know we have to credit the note receivable, right? We have to take that off the books because he no longer owes us. We know the note receivable is going to be for what? $10,000. And we also know the calculation for the cash amount. We already discussed that. We said the cash was going to consist of $10,000, which is the principal, plus the interest. Now, how do we calculate the interest? Easy. $10,000 times 0.10 times 1 year. Your interest calculation is always principal times rate times time. All the time. Principal times rate times time. We already know the numbers, guys. $11,000. Now, as you can see, your debits and credits are equal, right? So we have a couple of things we have to do. Let's consider this previous transaction where we had debited interest receivable for 667. We said these guys owed us interest for 667, but now it's May of the following year, and they have paid us through this cash the 667 of that interest receivable. So what should happen to that account? You got it. We have to take it off the books. So we're going to credit interest receivable for the 667. And we're still not balanced. We're still not balanced, guys. Why aren't we balanced yet? Why don't our debits equals our credits? Very simple. We've accounted for in the previous transaction 8 months of interest that was earned, technically. And now we're in May of the following year. And so of this 12-year particular note, we've already accounted for 8 months of interest. Now we have to account for what? 4 months of interest. So we're going to credit interest revenue. And it doesn't matter the order, guys. Interest revenue doesn't matter the order where they come in at. Interest revenue for 4 months. Now, we could be real smart, Alex, and just subtract this from 1,000. Because we know our total interest is 1,000, and we know we've already recorded 667 of it. But we could do the calculation too. So we could say, what, 10,000 times 0.1 times 4 over 12. And that should give us the difference. What is that? 333? Yep. And so this is an example of how you should go by applying and accounting for your interest receivables. That's chapter 8, guys. That's chapter 8. And so we have only yet one more chapter to look forward to lecturing, and we're pretty much set. We're pretty much set. And so I will see you for the following chapter.